Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. My goal is to help you put your money where your mouth is and invest in great companies. If you are like me, you love food and you love investing. So, it only makes sense that you will love this channel too. In this video we will be exploring SBUX and finding if the world famous coffee chain would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Starting with the 1-year chart, we see that SBUX had a CAGR of about 47%. Zooming out to the 5-year chart, we see that SBUX had a CAGR of 13%. Amazing returns in the last year, though this seems to be an anomaly as the 10-year CAGR is 13%. I would expect a regression to 13%, meaning that there is probably a share price drop in the near future given no large fundamental changes occur in the business. Speaking of the fundamentals, gross margin looks good at 27%. Revenue has compounded at 7% over the past 5 years, most recently hitting $34 billion on a trailing 12-month basis. Really strong revenue results. Love it. Looking at free cash flow, we see a minus 25% CAGR over the last 5 years with capex negligibly decreasing. Stock-based compensation is growing at a 3% CAGR. This is actually pretty worrisome. Free cash flow is falling. Even if we remove 2018 data, during which Nestle paid Starbucks $7.15 billion for the right to sell Starbucks products outside of Starbucks coffee shops, we see that free cash flow fell by a CAGR of 5%. On second thought, this free cash flow fall is likely due to the China lockdowns. China has recently reopened, so it seems reasonable to expect that free cash flow will start to pick back up. Next, weighted average shares outstanding has been decreasing at CAGR of about minus 4%. This means that SBUX is aggressively buying back shares. This decreased share count will increase the per share metrics and increase the value for shareholders. Now, return on invested capital. Return on invested capital increased during the period at a CAGR of about 4%. Going from 21% in 2018 to 26% most recently. This is great. Love to see return on invested capital increasing over time. A favorite metric is cash conversion cycle, a measure of operational efficiency at the company. Going from a peak of 29 days in 2018 to -1 days most recently, SBUX is demonstrating strong supplier leverage and inventory control. A negative cash conversion cycle means that a company's inventory is sold before they have to pay for it. Love to see the cash conversion cycle trend downwards over time. Last, let's explore SBUX's debt metrics. For SBUX, the current ratio is 0.8. The debt to equity ratio is 1.3, and the net debt to EBITDA ratio is 3.3. So now that we know all about the fundamentals of SBUX, should it be added to the portfolio? Before sharing my final thoughts on that, please subscribe, like, and share this video. Your support means a lot to the Food Fund, and your continued viewership is a huge help to grow the channel. Now, let's get into the final thoughts. Okay, let's write out some key values for SBUX. The most popular coffee chain in the world has a gross margin of 27%. As mentioned in other videos, I like to start with gross margin because if this sucks, then no matter how great the other metrics, the company will be terrible. The 5-year revenue per share CAGR is 12% and the 5-year free cash flow per share CAGR is minus 23%. Again, if we exclude 2018 data, free cash flow per share still fell at a minus 4% CAGR during that period. I will make an exception and use minus 4% here. A return on invested capital of 26% is solid and shows very good efficiency. Next, the cash conversion cycle of -1 is really nice. Regarding the debt, a net debt to EBITDA of 3.3 is a little more than ideal, but is not necessarily a deal breaker. It means the company would take a little under 3.5 years of EBITDA to pay off its debts. So from a fundamental standpoint, SBUX is strong, and I would only expect it to get stronger as China returns to form and continues growth and expansion. Last, let's look at valuation. Starbucks is somewhat overvalued relative to the S&P 500 with a ratio of 1.4. As we have previously mentioned, strong fundamentals often command a premium to the market. The price to earnings growth, or PEG ratio, of 1.7 tells me that Starbucks may be reasonably priced relative to its projected earnings growth. In summary, Starbucks is a strong and growing company and the valuation does not seem super expensive here. This company is clearly going on the watch list and I would love to pick it up for just a little bit cheaper, because, you know, greed. Many thanks for watching. What do you think about Starbucks? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.